This is Tim Ray with True Rate Mortgage Group. Today we're going to talk about a word that you probably have heard before. It's called debt to income ratio, DTI for short. Debt to income ratio is what lenders look at to approve you on a loan. Today we're going to talk about it, and we are going to specifically talk about ways that you can help your debt to income approval so that the lender can say yes to your loan and show you the money.
Show me the money! Jerry, you better yell! Show me the money!
All right, so what is debt to income ratio? Debt to income ratio is nothing more than what percentage of your monthly income goes towards paying debt. Now, don't think about utility bills and things like that. Think about credit cards, installment loans, and the mortgage. So for example, let's say you had a total of $2,000 in monthly bills when we add them all up. And let's say you make $6,000 a month. If you divide 2,000 by 6,000, you'll see that your debt to income ratio in that example is 33%. You get it? The problem today is home prices seem to still be elevated, interest rates are high, insurance is high, and actually taxes are high. Everything is high, so your debts are going to naturally be higher. And unless you've gotten a new job or a new raise or you're making a lot of money, it seems like it's becoming tougher and tougher to qualify. 2 years ago, I wrote this book, and it was designed for first-time home buyers. But you know what? This book did not reach the national best-selling list, unfortunately. And the reason why is because, well, not the reason, but I think one major reason why is because it didn't address the reality of where we're living today. And where we are living today is in a world where getting approved is harder than it has been in a long, long time. You know, there was a time when rates were really low. That helped with payment amounts. There was a time when home prices came down. Today, neither of those seem to apply. Home prices are still high, rates are still high, and like I said, insurance and taxes and everything is high. It's tough to get pre-approved today. What can you do as a home buyer today? Well, there's 6 things I recommend every home buyer or prospective home buyer do to get approved. And I'm going to go over them one by one. You ready? Let's get started. The number one rule of thumb here for your debt to income ratio, I think, is to begin with what is currently on your credit report. In other words, you need to Dave Ramsey your accounts. Now, if you don't know who Dave Ramsey is, he's like the godfather of debt reduction.
A finance professor that's broke is like a shop teacher with missing fingers.
He's got a ton of videos online on YouTube, and I'll link a couple down here if you'd like. But really what Dave's whole purpose is to get you to be in control of your debt. Now, there are techniques, there are pretty cool things where you can analyze your debts and look at the interest rates and choose the credit card debts with the highest interest rate. But at the end of the day, guys, you're going to want to eliminate the highest payment items on your credit report if possible. Keep in mind that in lending, we don't really look at what you owe per credit card. We look at what the payment is associated with it. So it's really important that you choose wisely which credit cards you want to eliminate. That would be step one, and have a plan to start managing your credit card debt. Number 2, how's your income looking? Are you salary? Are you making as much money as you could be? Is it time to go talk to your boss and ask for a raise? I don't know. That's easier said than done.
Well, I generally come in at least 15 minutes late.
But more importantly, are you hourly? Because if you're hourly and you're not working 40 hours a week, then you could be working what we call variable income. Now, variable income is calculated much differently than full-time income. So if you are an hourly guy and you can work, or at least start working 40 hours a week, it is going to help you if we can calculate your income using full-time calculation measures versus variable income. This is very important. Get with your lender to discuss this strategy, but you are going to want to work 40 hours a week consistently, and the underwriter is going to be looking for that. I highly recommend you talk to your lender about this because this is very important. I can't tell you how many times variable income calculations completely throw the numbers off. But this is something you can possibly control. So jump right in there and get your hours where they need to be. Got money saved up for that down payment? Good for you. But hold on a minute. Be careful with that money. A lot of people think Immediately, I have all this money saved up for my down payment. That's going to give me my best payment and my approval. But here's the thing. If you have a lot of debt reporting on your credit, your lender may want you to take some of that money and pay down some of that debt to help your debt ratio. So don't assume that just because you have all this money saved up for your down payment, that you're going to want to apply it directly to reduce the loan amount. Now, you very well may want to do that, but it's important to understand that if you have other high interest rate debt on your credit, it might make sense to apply some of that money that you have worked so hard to save up to pay it towards removing that debt beforehand. Again, talk to your lender about this. All right, next up on the list, guys, this one's pretty obvious, but in today's market, you have to shop the interest rates. Now, there are lenders all across the board, different types of lenders. We have videos on this. There are retail, there are broker, there are banker. Here's the deal. Bottom line, you have to shop interest rates. Some lenders are going to offer you sometimes as much as a point or a percent, I should say, higher than another lender. When you do the math with where loan amounts are today, you could end up paying $150 more per month on the exact same loan, depending on which lender you go with. It's really important today to do that. So shop the rate. It's a very important part of your debt to income ratio. Got to get the best rate today, guys. Got to get it. It's not like the days of 3 years ago when everybody had 3% interest rates. Today, it matters more than ever. Make sure you're in the right loan product. There are a lot of loan products out there, guys. There are some what we call non-QM loans. There are regular loans. There's FHA, conventional, VA, USDA. There's a ton of loan options out there today for you to choose from. Here's the deal. Some loans are going to allow you to have a higher debt to income ratio. So if you're busting your butt to pay off debt or increase your income or all the other things we've talked about, but if you're sitting in the wrong loan product, then you're fighting a war that you don't even have to fight. Make sure that you have all loan options on the table. A good lender will do that for you. To give you an example here, we had a borrower a couple of years ago who was talking to another lender for, I don't know how long, let's just say 6 months. It was a long time. He was working with a loan that we call a bank statement loan. Now, a bank statement loan is a great loan if you have to go this route. It's a little tricky. They don't look at income. They just look at your bank statements to confirm your income. Anyway, this product, because it's a little tricky, was giving an interest rate north of 8%. Now, I don't remember exactly what the lender quoted, but I just remember it was in the upper 8% range. When we met this borrower, we determined that this loan product actually wasn't necessary. So we actually flipped him into a different loan product. And I won't give you the rate here because I don't remember exactly, but I remember it being about 2% lower in interest rate. That saved him about $800 a month because we were fishing in the right pond. Next up on the list is seller concessions. This is a hot one today because of all that is going on in the world today. There are options out there where the seller will actually give you money back or help you make your closing happen to buy their house. Usually people think when they get money from the seller, hey, I'm going to apply it to pay the closing cost, or I'm going to use it to buy the rate down, maybe do a 2-1 buy down, something like that. But when we're talking about debt to income ratio, if let's just say you're getting $10,000 from a seller that you are trying to buy a home from, immediately your lender may want to take that money and apply it to pay your closing costs or buy your interest rate down. Now that's great, but what if you have a high debt to income ratio? And what if you have credit card debt with payments that are outrageous? The average credit card rate, I think I just heard, is in the mid-20s. What if you were getting $10,000 from the seller and you had all this money saved up already outside of that? What if you took some of your money and paid those credit cards down and then used the seller concession for the closing costs? It would give you a better debt to income ratio. It would give you a better approval process. And did you know that sometimes when your debt to income ratio is a little lower, you can actually get a little bit better of an interest rate? That may not be for everybody, but it's worth knowing that. So many times we get a call from a buyer who was recently denied by another lender because their debt to income ratio was high. And then a simple reevaluation of these things tells us that there are options on the table. If they just would have looked at one or two of these options, they would have found a solution. Unfortunately, it's not required for a lender to go above and beyond to look at all these different things, but you can, and you can use this video to learn and know these things. As we always say in our office, no matter how doom and gloom your loan is, there almost always is a way to get the loan done. Give us a call today to get started.